The president's concern now on Truth Social. He says, everyone keep oil prices down. I'm watching. You're playing right into the hands of the enemy. Don't do it.
Trump just did the unthinkable. Begged China to buy oil from Iran. Why? Because without cheap oil, the U.S. economy could implode. President Donald Trump is now publicly asking world leaders to keep oil production high. He's warning that rising prices would play into the hands of the enemy. His message couldn't be clearer. Keep oil cheap or the U.S. economy could fall apart. The problem started after a major conflict between the U.S. and Iran. There are growing fears that Iran could cut off its oil exports and block the Strait of Hormuz. The Iranian parliament had even voted in support of blocking this passage. Unfortunately, got the U.S., this narrow sea route is where 20% of the world's oil passes through. If Iran blocks it, oil prices could skyrocket overnight. What is even more shocking is that Trump has now told China it is allowed to buy Iranian oil. This goes directly against his past policy of maximum pressure on Iran. He also spent years pushing for energy independence and punishing countries that worked with Tehran. But now, with oil prices rising, Trump is quietly changing course.
Because it certainly took Treasury and state officials by surprise. It took the oil traders by surprise. I think it took all of us by surprise.
Why the sudden shift? Because Trump knows if oil becomes expensive, the U.S. economy will crash fast. His recovery plan depends on cheap energy. If gas prices rise, transport, food, and factory costs all go up. Voters get angry. Inflation comes back. The economy slows down. Trump isn't making a calculated move. He's cornered. And now, in a stunning reversal, he's relying on China and Iran, the very countries he once tried to crush, to save the U.S. economy. But what if Iran says no? What if the Strait of Hormuz gets shut down? This crisis is only beginning. The White House is out of moves. The oil market is calling the shots now, and Trump is no longer in control. So subscribe to the channel, and let's dive into the full story. It's a shocking shift. After years of punishing countries for trading with Tehran, including sanctions on Chinese banks, Trump is now quietly signaling that those deals are acceptable. The law hasn't changed, but the enforcement has. And it's all because he needs China's help to keep Iran calm and oil prices down. Why is Trump allowing this? The real reason is that he needs China's help. With tensions rising, even the hint of disruption in the Strait of Hormuz has traders on edge. A major supply shock there could send global prices soaring. That would destroy Trump's plan for economic recovery. Trump is hoping that if China continues to buy Iranian oil, it will use its influence to stop Iran from closing the strait. This creates a dangerous contradiction. U.S. sanctions still exist on paper, but Trump is bending the rules in public. It sends a mixed message, one that weakens Washington's credibility and makes global markets nervous. In other words, China becomes the one country that can convince Iran not to cause an oil crisis. This makes China more important than ever in global oil politics and in Trump's strategy. Trump's decision is confusing. Just recently, Treasury Secretary Scott Bessent was working to shut down Chinese banks that traded with Iran. Those banks were accused of helping Iran get around U.S. sanctions. Now Trump is saying those same deals are acceptable. But he's not stopping there. Trump also wants China to buy more oil from the United States. He said, hopefully they will be purchasing plenty from the U.S. also. He is trying to make both things happen. Let China help Iran stay calm, while also getting China to buy from American producers to keep prices low. It's a risky plan. China has a lot of power here. It is the biggest buyer of Iranian oil, over 1 million barrels per day. If China decides to pressure Iran, it could help keep the Strait of Hormuz open. But if China decides not to get involved, or if it is angry over U.S. sanctions, Trump's entire strategy could fall apart. That's why Trump isn't just pleading with foreign powers. He's also turning to American oil companies, hoping they'll ramp up production to stabilize prices. But there's a problem. Shale companies are ignoring his calls to ramp up output. They say it's too risky, and they're not in the business of rescuing Washington from another crisis. After years of boom and bust cycles, U.S. oil firms have become more cautious. Wall Street investors are demanding returns, not risky spending. These companies remember how expensive it is to ramp up production only to lose money when prices fall again. Even with oil nearing $80 per barrel, shale executives are staying on the sidelines. They say they won't throw money at short-term politics. One oil CEO put it simply, "We are not the swing producers anymore." In other words, they refuse to act like the U.S. can control the global oil market with a few drills and frack jobs. Those days are over. Trump has also pushed the Department of Energy to find ways to boost domestic supply. But the truth is, the DOE has no magic button. Oil projects take time. Drilling permits, environmental reviews, and labor shortages all slow the process. It could take 6 months or more before any new wells impact supply. What's happening now is more than just a policy failure. It's a political embarrassment. Trump built his brand on U.S. energy dominance. He promised cheap gas, energy independence, and control over the market. But now, in a moment of crisis, he can't even get American companies to cooperate. It's a clear signal that the oil industry no longer trusts political pressure. These companies believe short-term moves from Washington only hurt them in the long run. Instead of drilling, they're buying back stocks, paying dividends, and keeping investors happy. This puts Trump in a dangerous spot. He can't control U.S. oil companies. He can't order them to pump more. And that leaves him completely exposed to foreign producers. That's why he's turning to Saudi Arabia. That's why he's asking China to keep oil flowing from Iran. And that's why he's giving mixed messages about sanctions. He needs oil prices low at any cost, even if it means bending his own rules. Without U.S. oil companies stepping up, Trump's whole energy strategy now depends on countries that don't even like him. And that's the real danger. Analysts warn that a closure of the strait could trigger an immediate oil price surge, potentially pushing crude to between $80 and $110 per barrel. That would raise gas prices in the U.S., increase food and shipping costs, and cause inflation to return fast. The Federal Reserve would struggle to respond. A recession could follow. This is Trump's worst nightmare, and the only way to stop it is to convince Iran not to make that move. Trump is betting that China can be the one to keep Iran calm, but only if he allows them to trade. In the wake of President Trump's recent public remarks suggesting that China may continue purchasing oil from Iran, a cloud of uncertainty has settled over Washington's long-standing sanctions regime. U.S. law, particularly the Countering America's Adversaries Through Sanctions Act, CAATSA, of 2017, mandates that any country or company importing Iranian crude must face punitive measures, unless granted an explicit waiver by the Treasury Department. Yet, in his June 24th statement, Trump appeared to ignore this rule, prompting confusion not only among foreign buyers, but within his own administration. How then can such an apparently contradictory message coexist with the ironclad sanctions that Congress imposed under CAATSA? Is Trump bypassing the U.S. Congress again? When challenged, the White House was quick to clarify that the sanctions remain fully in place and that no formal policy change has occurred. The Treasury Department itself has continued to press forward with enforcement actions against so-called teapot refineries in China, small, independent operations that had been evading detection while importing Iranian oil under the radar. These refineries were specifically targeted last year in an effort to starve Tehran of revenue for its nuclear and missile programs. Yet Trump's rhetoric gave market participants reason to believe that U.S. resolve might be wavering, undermining the credibility that underpins any sanctions regime. What implications might such a gap between words and deeds hold for America's broader influence over the global oil trade? To appreciate the stakes, one must understand that CAATSA and related statutes do not allow the president mere discretion to wink at violators without formal action. The laws require that any breach of the Iranian oil embargo by foreign parties triggers secondary sanctions, financial penalties and trade restrictions designed to isolate offenders from the U.S. economy. In practical terms, this means that Chinese banks financing crude purchases or shipping firms carrying Iranian barrels should be cut off from dollar clearing services and major trade in goods. Treasury's Office of Foreign Assets Control has routinely issued general licenses to clarify exceptions. But these licenses do not cover ongoing imports of Iranian oil. When those waivers expired earlier this year, China's official imports of Iranian crude plummeted to nearly zero. Could a mere tweet really upend such precisely calibrated legal machinery? Worse yet, the internal confusion has been on display for all to see. Treasury officials, when pressed by reporters, admitted they were still clarifying the president's intent and reviewing whether any existing waivers might be implicitly revived. Among seasoned sanctions lawyers, this admission was tantamount to saying that Wall Street might see new guidelines any day now. Guidelines that, until formally published, do not exist. Investors and foreign ministries watched in disbelief as U.S. sanctions policy appeared to hinge on the next few press releases. Might this ad hoc approach invite other countries to test the boundaries of American enforcement? The immediate impact on oil markets was dramatic. On June 23rd and 24th, benchmark Brent crude fell by roughly 6% as traders braced for the possibility of renewed supply from Iran. Supply that the world had believed was choked off by strict U.S. measures. Within hours of the ceasefire and Trump's statements, Brent fell to a 2-week low around $67 per barrel, while U.S. West Texas Intermediate dipped to the mid-60s. Such swings reveal how sensitive the oil market remains to both geopolitical flashpoints and the credibility of U.S. sanctions enforcement. Since then, oil prices have eked out a modest recovery, rising by about 1% on June 25th, as investors weighed fresh data showing sustained U.S. demand. Yet this rebound has proven fragile. Traders remain skittish, acutely aware that any sign of policy flip-flop could unleash another wave of selling. The market's growing efficiency, fueled by real-time satellite tracking of tankers and advanced risk analysis, means that any crack in America's sanctions armor is quickly capitalized upon. Beyond the oil patch, the broader economy feels these tremors acutely. A sustained spike in energy costs tends to ripple through inflation metrics, raising transportation and manufacturing expenses that ultimately land on consumers' bills. Federal Reserve officials, who have been closely monitoring core inflation, must decide whether to temper their plans for rate cuts or risk stoking a resurgence in price gains. Recent expert commentary suggests that the Fed may be underestimating the stickiness of inflation in the face of renewed geopolitical risk. Some even argue that a delay in easing could heighten recession odds, now estimated at around 30%. How will the Fed balance the twin objectives of growth and price stability if oil prices continue to be unstable? Because of these uncertainties, the Fed is saying it would have to wait before considering any rates cuts. Trump does not like this because he has been putting pressure on the Fed chair, Jerome Powell, to cut interest rates. More instability will only lead to the Feds keeping the high interest rates in place. The International Monetary Fund has added its voice to the cautionary chorus. IMF Managing Director Kristalina Georgieva warned that any closure of the Strait of Hormuz, a narrow choke point through which 1/5 of global oil flows, could trigger a shock severe enough to dent growth prospects worldwide. Such a disruption, she noted, would not only lift energy prices skyward, but erode business confidence, potentially tipping fragile economies into contraction. While the recent ceasefire has temporarily calmed the oil markets, the threat hasn't gone away. Diplomatic tensions are rising, and the world's central banks remain on edge, knowing that one wrong move in the Strait of Hormuz could trigger a global shock. Trump is betting everything, sanctions, alliances, and even credibility, on a fragile hope that China and Iran won't push back. But did this desperate gamble buy him time? Or just hand Beijing the upper hand in global oil politics? What do you think? Is Trump still in control, or is the U.S. economy now at the mercy of its rivals? Drop your thoughts in the comments, and don't forget to subscribe for more.